This is our Forex blog for August 2nd, 2013. Most days I'm spending all my time trading and working on automated systems, which will result in signals for our traders. Tells you exactly when to buy and when to sell. Some days I'm not going to do the Forex blog because I'm too busy, but today I thought I would show what I consider the easiest way of trading, and that's using our currency index. And this works for all 8 currencies. I'm showing the top 4 right here: the dollar, the yen, euro, and pound. It actually lets you see each currency as a chart, and it lets you see double tops, double bottoms. It lets you see when a currency is just slowly going up, which means basically there's not that much strength, and when it breaks a trend line or the hourly moving average right here, it's very likely to go down, and you can see that's what happened here. The euro here was above its hourly moving average all day. All the time frame trends, real time, daily, weekly, monthly, all up. Found support here at the hourly, went a little bit underneath, and then broke out at the same time, approximately the same time the dollar broke down. Also, the yen was trending down most of the day, but the pound was the strongest, and you can see it went sideways for about 5 hours right here. This is a little rectangle pattern, and when this broke out and was so strong statistically all day, that the pound dollar was the best one to buy at 8:30. It's that simple. Let's bring that chart up, and so here's the chart, and you can see right at 8:30 when the dollar broke down and the yen broke out. This one went over its high, and it went from 51.75 all the way up to 5,300. 125 pip move. And even if you don't have or not using minute-based charts, you can use, for example, 50 tick per chart, 50 ticks per trade. Anytime there's 50 price changes, there's a new bar. Or you can use what we prefer ourselves, which are range bars. It shows a certain number of pips per bar. So whether, let's say you have a 5 pips per bar range chart, if it goes 5 pips in 1 second or 2 minutes, it shows 1 bar. It gets rid of a ton of the noise. So here you can see the 50 ticks per bar range, or 50 ticks range, actually tick chart here. It exploded up, and even if you miss that first wave, you have a nice little flag wedge pattern right here, and it went up another 40 pips. And then if you got into this little pullback right here, you lost a little bit. You got into this one, you made 20 pips. So you lose 5-6 pips, you make 20. And let me just show you why I like the range charts the best. These show certain patterns that are very duplicable across currencies. For example, anytime you have a strong trend of this magnitude, usually a 2 or 3 bar pullback with 1 bar up, it's a decent place to get in. You put your stop underneath here. Unfortunately, it took a while to break out. Maybe you got out with a small profit. You got this breakout of this little flag pattern again, and you can see you got in here at 30, out at 40. And with range charts, when the market's gone up too much, typically a 2-wave pullback, down, up, down, much better entry. I wouldn't consider this one. Down, up, down, much higher probability. Down, up a little, down. You're much higher probability. Down, up, bar, down. At least you have a chance to make money here. Down, up, down. You wait for it to go 1 pip over the high, it doesn't. 1 pip over this high, it doesn't. 1 pip over this high, you got a small profit. And these are just the top 4 currencies, but there's a slew of different ways to trade, with these tools. For example, the yen broke down around 2 from above its hourly to below it, and you could look for trades in the strongest one at that time. The euro is the strongest. The pound's also right up near its high of the day. It doesn't have that far to go above yesterday's high, and if it breaks out over yesterday's high, there's likely to be a ton of buyers. The euro yen's a little bit higher probability in more volatile currencies, so I'll show that one. We'll go back to a 5-minute chart. So you can see this trade at 2 o'clock when it broke out. Actually, it was a little bit before 2, you can see maybe 145. It broke out right here, and it went from 131.50 all the way up to 85. And again, a range chart is going to give you a lot more higher probability trade and lower risk, because you can risk literally 6 or 7 pips on range charts. When the market's not moving, you really can see it too. Plus, I find a lot of times when the market goes up, you're either going to get a pullback or you're going to get a series of up down bars like this. and so when it breaks out over the high and it wasn't really able to go down that much, it's a pretty high probability trade. And most of the time they'll go up 2 waves, so 1 wave, 2 waves, you're out. You made 16 pips, 15 pips. Buy this little pullback because there's a 3-bar pullback, and then you just kind of, when it's up near the highs, I tend to trail the stop underneath the bar's lows, and you're out somewhere around 80. In at 60, out at 80, make 20 pips. And that's pretty much how you use this. You can spot double tops, double bottoms. You can see when a currency's doing nothing for many hours and then breaks out. It's very likely to trend. This is one of the highest probability patterns you will find on the currency indexes. You saw it here, and then again later in the day at 3:30. This was absolutely explosive, and you want to buy it against the weakest one. One of the weakest ones was the yen. It was already weak. The daily trend's weak. The monthly trend's extremely weak. It's right back here at major resistance at the hourly. At 3:30, the pound yen is very likely to explode up. And most of the time when one's going up and the other one's going down, you're going to make 20 to 50 pips. Alright, so here's this individual chart at 3:30. And you can see at 3:30, the yen kind of went sideways and slightly up, down, up, down. But if you were watching this chart and you saw the pound break out at 3:30, you got in this trade here with your stop underneath here. It kind of went up a little bit, it's kind of chopping around. I put my stop underneath here, and you might have got stopped out of here, but you lost 5-6 pips. And unfortunately, it kind of pulled back at a 3-bar pullback. I usually would wait for it to break out over the bar's choppy sideways action. You get in it again right here, and this one, just absolutely exploded up. Once it goes 20-30 pips, you just want to kind of trail the stop underneath the bar's low. And you can see you're in at 75 here, out at 15 for a nice 40 pip win. You lose 5 pips, you make 40 pips. And that's the beauty of this methodology. And I'll show one more example. And we'll pick another currency that maybe is stronger or weaker. Let's take a look at the Swiss. You can see the Swiss was right at yesterday's most actively traded price. It's major resistance area. There's people selling it. Anyone who was long yesterday is long from this price, and so price was underneath that area. They were down money. When it comes back up to it, it's likely to there's likely to be some exit orders there, so people can get out of the trades at break even. It's just common, basic human nature. Comes down to the hourly moving average. It acts as support, which you can also see on the dollar here. The yen here, the pound here. The hourly moving average of the currency indexes is major support if it's above, or resistance if it's underneath. So this one was kind of chopping around here inside these two support resistance areas, and when it broke out at 8:30, you can also see the dollar at the same time exploded down. You're going to have a very high probability trade selling the dollar. So here you can see, you have nice top up here, kind of a slow up move. And like I've said before, a lot of times you'll get 3 to 5 bar reversals. 3 bars up, 1 bar down. You can see this bar here is bigger than the normal 5 pips per bar. So is this one here. If there's any gaps in price, it shows that. And so anytime you see a move down after a couple bars up, or vice versa, with a bigger bar than normal, it's usually a continuation trade. Also gaps. Typically you'll never see gaps in range charts. So if you ever see a couple pip gap and where the next price opens at, you know that price is moving so fast that it's skipped a couple price pip levels. So when it breaks that trend line, you're in. Maybe it's 70 at the worst if you're a little slow, 72, 73 if you're a little faster. And you can see just straight down. Once it starts consolidating, you put your stop over the bar's high, and you're out at 25 right here. Short at 70, out at 25 for a nice 45 pip win. And a lot of times these explosive moves will go at least 2 waves. So that's first wave. Second wave right here, you're not going to make as much usually on the second wave. You made 5, 15, 25 pips. But very predictable with the currency index, because the dollar is weak and the Swiss is strong. And a lot of times you will get a pullback in one and a pullback in the other. You can see the dollar made a really decent pullback up. The Swiss went all the way to the upper containment band, pulled back, You can see it's quite strong while the dollar's weak. Obviously the pound was the strongest one of all. This is a great time to buy because you got a dip in one of the stronger currencies and a retracement up in one of the weaker currencies. It's likely to continue its trend, and it does.